Okay, welcome to the December 12th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk about the South American crop and what's going on down there. And then we're going to talk about, excuse me, we're going to talk about palm oil and the latest Malaysian Palm Oil Board data for November and the implications that that has more broadly for the market. And then we'll talk a little bit about the changes that USDA made in their WASDE report last week. Sorry. And then I'll take any questions. All right, so let's see if I can do this properly. All right. So for South America, I was a little surprised, although I guess I shouldn't have been, to find out that conditions in Argentina are actually significantly better than I thought. You can see on the right-hand side that that if the forecast actually verifies, then the soil moisture levels or the accumulated precipitation, I guess, will be above average for the period from for the last 2 months, I guess. And that combined with planting progress, which isn't terribly slow, and we'll show here in the next slide, and temperatures, which have been pretty reasonable, especially given how hot it's been in parts of Brazil, mean that people are expecting the crop to be about what they expected it to be before, and which is to say that they expect yields to be about trend line. And that is important because it looks like, and we'll get into more detail on this when we talk about palm oil, but it looks like that the world is probably going to be short a little bit of vegetable oil starting in the first quarter, and then depending on the size of South American production, either reversing in the second quarter or continuing in the second quarter. And with, like I said, with the concerns about Brazil, then that makes the Argentinian crop that much more critical to world supplies, especially since they are the larger exporter of vegetable oil into the world than Brazil traditionally anyway. And so it is generally a good thing that Argentine farmers are finally catching a break. When I was talking to Joao about this morning, he said, "Oh, they really deserve a break, don't they?" And I said, "Yeah, these guys really do. They've had a rough couple of years with La Nina, which, you know, last year was just one of the worst performance years I've ever seen or that I can ever remember in terms of a whole country's performance relative to trendline yields." And so a bounce back would be good for the farmers, and also keep a lid on world vegetable oil prices. But to get there, they do need the forecast to verify. And one of the reasons I guess I hadn't really thought that Argentina was doing as well as it is because every time I look at the radar, I don't really see a lot of rainfall. There was that one storm that we talked about that sort of hung out in southern Brazil, in Uruguay for quite a while, but that never really, other than one time, didn't seem to push into Argentina. And it didn't seem to push into Argentina into where they grow soybeans, which is Las Pampas. And so that bit is a little bit surprising, but it is also still relatively early in the in the growing season in Argentina. So if you look at planting progress, they're just about halfway finished, or just a little bit more than halfway finished, but they're behind where they've been the last, they're behind the 5-year average, but ahead of last year. Last year, of course, was impacted by by the drought. So there still is a lot of time left to recover if the rains that are forecast don't materialize. However, as the shift to El Nino becomes more entrenched, I guess, the impact of that will be more broadly felt. And to the extent that it does raise temperatures a little bit or restrict rainfall a little bit, if rainfall up to the point where the pattern shifts back towards a little drier and a little warmer isn't sufficient to build up soil moisture levels, then the crop may struggle a bit. But right now, honestly, there's not a lot that I can say bad about Argentina's crop. Going forward, as they get a little bit more planted, we'll start talking about crop condition ratings and soil moisture levels. The Buenos Aires Grain Exchange puts out a really nice report every week. If you don't know where it is, ping me and I'll send you a link. But it's a really good report that talks about everything that's going on in each region of the country, and then has crop condition ratings and soil moisture ratings included in there. And it's super helpful in monitoring the Argentinian crop. But right now, like I said, probably better than I would have thought a week ago or 2 weeks ago. And that was reflected a bit in USDA's WASDE report, where they left Argentinian soybean production unchanged at 48 million tons. We're a little bit above that, and I would be, if conditions continue the way that they are right now, I would be really surprised if it wasn't a little bit larger than 48 million tons, which will ultimately, like I said, especially next summer, will be critical for world vegetable oil supplies. In Brazil, and in particular, this is Mato Grosso, the rainfall has not been sufficient to sort of keep supporting the crop. And there is roughly 15% of the crop that is currently in pod filling, not necessarily in the center west region. This is countrywide, but while that 15% are the obviously the earliest planted soybeans, and the bulk of the crop isn't planted until later, and they're not even entirely finished with planting that yet, but they're almost done. But for those beans, the early planted soybeans in Brazil, yields are probably not going to be that fantastic, especially for early planted beans in the center west region, where it has been unusually hot and, as the chart shows, unusually dry. Now, the weather forecast here, this particular forecast is not suggesting that temperatures will be above normal during the forecast period, but there have been several model runs that do suggest a return to hotter than normal and drier than normal conditions in the primary growing regions of Brazil over, I think, starting next week, and then into the end of the forecast period, which is kind of the last thing that they need right now. I've said on this call so many times about, ugly soybeans can yield well, but the trick is they have to be alive when the rain hits them. And I don't think that I think there have been enough timely rains that hasn't necessarily been true. And Joao sent me some pictures he was in Mato Grosso recently, and he sent me some pictures of some fields that looked really, really good, that would suggest that even though rainfall hasn't been at normal levels, it has been timely enough that it's supporting crop development still. Of course, the amount of water that the crop requires increases as the crop grows. And so the pressure for more timely rains and greater rainfall totals going forward will increase, and particularly if the heat wave if the forecast heat wave does materialize, then it comes at it not a great time. I don't know if there's ever a great time when you're growing a crop for a heat wave, but given the fact that Mato Grosso just sort of went through a hot and dry period and then got a little bit of rain, not that much, as temperatures cooled, and then maybe we're going to go back into hotter than normal temperatures again. That doesn't give the soil enough time to recharge, even if you do get timely rains. So then it means that what has to happen is essentially when the plants need moisture, you need to have rain. And if you are in hotter and drier than normal conditions, that becomes much more difficult. It does seem like we probably are, and particularly with 15% of the crop entering pod filling, and this doesn't mean that over the next couple of weeks that we're going to, this isn't like the US where once part of the crop enters pod filling, the rest of the crop follows relatively quickly. Brazil is so huge that, and they plant beans in such a wide variety of latitudes that these are the earliest planted soybeans. It's relatively small portion, and it's 15%, but relatively small portion of overall production. And so there will be additional beans that develop to that point, obviously, as we move forward through time, but it's not like we're going to go 15, 30, 75% of the crop going through pod filling the same way we would in the US. It's probably going to be much smaller incremental increases until we get into the main part of the crop, or the bulk of the crop planted, I guess, around the same period, which will be coming up in the next 4 to 6 weeks, I suppose. So as we were thinking about where do we really think Brazilian production is and where do we think Brazilian yields are, we put some numbers in, and if we just look at sort of the trend line yield in Brazil, that would suggest a crop of about 159 something. And that honestly felt a little low. I think that in Brazil, yields have probably improved a little bit more in recent years than the trend line would suggest, or that's certainly what last year suggested. And so I think if you have sort of trend line yield weather conditions, then you probably are 165 or so on Brazilian production. And if we get timely rains, I think we're probably still above 160. And then if we don't, it's hard to move the crop below 160 at this point, I guess, is what I'm really trying to say. USDA cut 2 million tons out of production in the WASDE report, but they're still at 161, I think. And so we're going to cut our yields, but we probably will not be, I don't know, I would be surprised if we're significantly below 162, maybe somewhere in there. We'll go through sort of state by state and look at the yields and kind of figure it out. But I would be real surprised if we would be below that. And my tendency would be to favor higher yields rather than lower yields, again, because of what we saw last year when conditions were far from perfect or supportive, and Brazilian farmers still produced a really large crop. Now, part of that is that, again, because Brazil is so big, you had a big variety in conditions. So Rio Grande do Sul looked a lot more like Argentina. Mato Grosso looked like the garden spot. And that may reverse a little bit this year. However, planting delays in RGDS mean that hitting trend line is going to be a little bit more tricky. That said, there's a lot of soil moisture there, and so they shouldn't need a whole lot of rain through the end of the year to get to to support yields. However, they will still need some rainfall by the end of the year, but it shouldn't be that difficult. Mato Grosso, on the other hand, obviously needs rain and needs more than just timely showers that maintain soil moisture levels close to zero, essentially. Not really, but for our purposes, they're relatively close to zero. Again, this will have broader implications. South American production will have broader implications than just the current crop. The delays in soybean planting will have a knock-on effect on second crop corn, which ultimately could reduce U.S. soybean oil supplies if U.S. farmers next year decide to plant more corn than we think, because the world is short corn and prices remain high. Now, it's right now the soybean corn ratio would suggest that that farmers in the U.S. should favor soybean planting next year. A lot of it will depend on the average price during February, because that's revenue insurance. And so while it looks that way right now, excuse me, it doesn't necessarily mean that that's going to continue through February and beyond that into next spring. And then even beyond that, again, farmers make the majority of their planting decisions based on crop rotation. But even in years where we've seen the soy corn ratio relatively high, I've always been a little surprised by how much farmers prefer to plant corn over soybeans. There have been some years where prices have been relatively low. If you go back to like 2015, 2016, prices were relatively low. And at that point, you kind of think, okay, well, farmers should want to reduce their risk. And so because it's relatively expensive to grow corn, they'll probably plant soybeans so they don't have to do so many chemical applications. It doesn't take as much fertilizer. And then farmers would go out and plant as much corn as you would think they would have if prices were much higher and there wasn't really that risk. So it's one of those things that I think of in sort of rule of thumb terms, sort of like betting against the weather in South America generally is not a good way to make money unless it's a La Nina year. Farmers love to plant corn. Worldwide, farmers love to plant corn. And in the US, the number of times that I have been surprised, or the number of times that I've thought, okay, this is finally the year that farmers will plant less corn than I think, or than the market thinks, those just haven't actually been true that frequently. Most of the time, I would have been better off expecting more corn acres, and so now I just kind of expect more corn acres. All of that said, if Brazilian production, if the safrinha crop for Brazil is smaller, it does have knock-on effects, because then Brazil doesn't export as much, and again, then that just provides more incentive for U.S. farmers to plant more corn, despite the fact that expectations for corn ending stocks are now, U.S. corn ending stocks are now above 2 billion bushels, which is sort of the magic number in the same way that it is for palm oil, although palm oil is obviously metric tons. Okay, so let's run through some of the changes that USDA made to their balance sheets. For the US, they didn't really make any changes to their soybean complex balance sheets. So we'll just talk about what they did in Canada, which is not that huge. However, they did raise their expectation for the Canadian production, which raised their crush forecast, which raised their canola oil supply forecast. And they've split that additional production, primarily adding to exports, and then whatever was left over basically added to domestic usage. With domestic usage at just over 1 million tons, that makes a lot of sense. There is still a little bit of anticipation that maybe maybe the Canadian vegetable oil market will start to look more like the US vegetable oil market in terms of big growth in biomass-based diesel feedstock demand. However, when we've sort of modeled it out, even though our estimate of usage and our estimate of canola oil usage based on the data that that Stats Canada reports is relatively low compared to sort of, again, kind of what I expected when I started that. We're above where USDA is, but it still isn't this big explosion in demand. If anything, the explosion in demand is in Canadian canola oil exports to the US, because the US demand for vegetable oil is so high right now. The changes that USDA made kind of balanced a little bit, but they let their stocks go up they let their stocks go up. I don't think that's right, actually. Maybe it is. It increased their stocks either way. And so let's see. You can see they raised their crop by 1 million tons. We're a little bit behind in our adjustment of the Canadian canola crop, but we'll be up by probably a little bit more than 1 million tons in our crop. And some of that will go to crush. Most of that will actually fall to exports this time, only because we're kind of bumping up against the capacity for crush. And so raising our crush much above 10.3 million tons is a little difficult. I think the record crush, well, it was 10.3 something. So we can get there pretty easily. And then next year, I think we will have a bigger crush, because it will there will be some additional capacity coming online. I think I have to check our list, but I think next year, I think there might be some additional capacity coming online. Outside of that, they also raised their export forecast, I'm sure very much for the same reasons that we did, and then they let a lot of that fall to ending stocks. The ending stocks thing is one of those areas where we have predicted tighter ending stocks than Stats Canada has predicted the last couple of years, and it seems like there probably is just a level that's about it's somewhere between sort of 1 and 1.5 million tons. That just seems to be sort of that's how many canola seeds are laying around, kind of thing. So if we're at the bottom of canola stocks in Canada, there's still 1.5 million tons at the bottom of silos and in transit and that kind of thing, because it doesn't seem to be able to sort of get down below that. Given what USDA's balance sheet looks like, I'm surprised that they didn't let a little bit more than that fall to ending stocks, but they're already above us. So much like us, I think that they may have wanted to be lower in recent years, and then Stats Canada has kind of trained all of us to expect a little bit higher ending stocks than we would think, basically. And part of it is Canada has a relatively large and pretty variable residual demand. Their animal feed waste and dockage is equivalent to our soybean residual, and that thing can vary pretty widely. And so it's large enough that you could almost set ending stocks wherever you wanted, and then just let the residual float around. And it's so big that people would have a hard time arguing that your residual number was wrong, because it's so big and it's varied so much throughout the years. The better than expected production in Canada also probably suggests that maybe the US crop is a little bit bigger than expected. We'll find that out next month when the USDA releases their annual crop production summary. report along with the WASDE around January 10th or 12th, somewhere in there. And hopefully the US crop is a little bigger. The US can use pretty much all of the soybean oil or all the vegetable oil that it can get its hands on right now. And like I said, it does seem, if you look at sort of aggregated numbers relatively broadly, it looks like the first quarter could get a little tight or a little bit tighter than it has been. After that, then as long as we get South American production and palm oil production comes back from sort of the seasonal decline and is not too badly impacted by El Nino, then it looks like supply and demand get a little bit more balanced after the first quarter, and potentially you have excess supply in the second quarter if you get a large South American crop. And then, of course, whatever that is probably carries over into the third quarter because you don't really get a lot of new supply coming on in the third quarter. And then the fourth quarter, you'll get North American production. And of course, whether the supply demand balance for vegetable oil is balanced there will depend a lot on the size of the US soybean and canola oil crops. All right, I put a timer on today to try and keep my time reasonable. And so I'm gonna try and hustle through the rest of this and get done in about 15 minutes. Okay, so the Malaysian Palm Oil Board released their monthly supply and demand data yesterday. And the big surprise, I guess, although it wasn't really a surprise, ending stock stayed about where they were the prior month. We did start to see the seasonal decline in production, as you can see on the chart here. However, production remains well above where it was last year and well above the 5-year average. And I think the big question is, will that continue, or will El Nino have an impact on production in the second half of the year? You can see we kind of have production relatively flat from the seasonal decline and sort of getting further away from the 5-year average as we get closer to the end of the marketing year. So what we've seen so far is that El Nino hasn't had a huge impact on rainfall in Southeast Asia. There have been a couple of relatively good storms that have helped bolster soil moisture levels, and the main impact of El Nino probably occurs over the next 3 months or so, or I guess the transition to an El Nino pattern in Southeast Asia will probably occur over the next 2 or 3 months. And then the question just becomes, how much soil moisture is available at that point? And then what does that look like? Does that mean that it doesn't ever rain in Malaysia again? Or does it mean that, like Mato Grosso, they get timely rainfall, just enough to sort of continue to support soil moisture levels? Or does it just go hot and dry like Argentina? And I would say that our production forecast is somewhere between the Mato Grosso and Argentina outcomes. And so it's a fairly severe reduction relative to what we would predict if there wasn't an El Nino this year. If we didn't have an El Nino this year, our line would look a lot more like the distance between sort of the 23-24 line and the 5-year average line would probably stay relatively steady throughout the year instead of what we have here. And so as the weather develops and as we monitor the weather over the next couple of months, we'll continue to change this, obviously. And if we get back to that sort of above the 5-year average for the whole year, we'll talk about why we do it and why it's important. But the main reason that it's important today is because of this idea that the world might be short vegetable oil in the first quarter. Seasonally, of course, palm oil production declines in the first quarter. And so it's tough to imagine that that even if prices rose a lot, that would be enough to kind of reverse the seasonal decline in output in Malaysia. So there's probably not a lot of relief coming there in the first quarter. but it's much more important for the second quarter, third quarter, fourth quarter of next year, particularly that second and third quarter, where in the second quarter, again, we might get a lot of additional supply from South America, or we will get a lot of additional supply one way or the other. It's just a question of whether that supply is sort of equal to the trend line yields or more or less. And then third quarter and fourth quarter will start to get into US supplies and North American supplies. And you can see there's a pretty big swing intra-year relative to last year, from the first 2 months where we were almost 4 million tons above the same period last year, to the last 2 months of the forecast, where we are expected to be, relative to last year, more than 10 million tons over 2 months, 5 million tons a month below where we were last year. Sorry. Yeah, those numbers are wrong. That 3.8 and 7.5, that should be probably just 38. Well, it's 38,000 and 75,000, I think, or maybe 7,500. Either way, it's a big change from the beginning of the year to the end of the year. Sorry about that. Okay, so more broadly, what does Southeastern Asian production look like? Indonesia is a little bit different than Malaysia in the way that we look at things and the way that we predict things. We still are a little early in our prediction cycle for Indonesia. So Indonesia is partially offsetting the declines that we have in Malaysia. However, the two countries are right next to each other. So if we get more rainfall than we expect in Malaysia and conditions are better there, they'll also be better in Indonesia. Similarly, if we don't get as much rainfall, then production is probably going to be short in Indonesia as well. And what that means is, even though there's probably a bigger space between the current year and the 5-year average or last year, the beginning of the year, than there is at the end of the year, it may be by the time that we get through Indonesian monthly production forecasts that Indonesia is a little bit lower than the 5-year average as well. And that would make this look a lot more like it did in 21-22 than our current forecast. And again, the timing of the overproduction or underproduction relative to our forecast will be relatively important because of the anticipated shortfall in the first quarter. Some of the other highlights from the Malaysian Palm Oil Board report included exports that were lower than we expected, and I think lower than the market expected, and that contributed to a little bit higher than expected ending stocks. And part of the reason for that is that the spread between palm oil and soybean oil has tightened up pretty dramatically here in the last couple of months. You can see it dropped from more than 35 cents in sort of September down to, maybe that's not September, maybe that's August. August down to about 16 or 17 cents now. We had anticipated that the spread between the two would narrow. We thought it would be much slower in doing so, and it would start much earlier. I thought that for most of 22-23, we would see a narrowing in the spread between soybean oil prices in the US and palm oil prices. However, we haven't really seen that as much, in part because Malaysian production was a little bit lower, and there was really strong demand for palm oil exports last year, both from just palm oil exports, but also surprisingly a little bit from biodiesel as well. And if that continues, and it seems like the world is moving in the opposite direction from biodiesel made out of palm oil, but if that continues, then the spread may continue to narrow. However, a significant chunk of Malaysian biodiesel exports went to Europe. And I don't think that I don't have to forecast what Europe thinks about Malaysian biodiesel, not Malaysian, biodiesel made from palm oil, wherever it comes from. Europe is not a huge fan of biodiesel made from palm oil. So whether that strength in biodiesel exports can continue. In strength, I don't mean that they're exporting, millions of tons of biodiesel each month to Europe. It's not that deep, but if it does continue, then the spread may continue to narrow. However, if there really is a shortage in the first quarter, there's a vegetable oil shortage in the first quarter, I would expect that any shortage, first quarter, second quarter, 2 years from now, would have a more significant impact on U.S. vegetable oil prices than it would on palm oil prices, because, of course, the U.S. demand for feedstocks is more heavily concentrated in soybean oil than it is palm oil. We make almost zero biomass-based diesel out of palm oil and import very little palm oil to turn into biodiesel. We import more of it each month, it seems like, or each year, to add to the feed industry and to go into some of the oleochemical applications, particularly those that have been priced out of soybean oil, but we don't use it a lot to make biodiesel. Now, one of the things that I heard was that part of the reason that Malaysian exports were a little weaker than the cargo surveyor data had indicated during the month is that while the spread between palm oil prices and U.S. prices narrowed, but remains still historically wide, if you look at Argentina, so this is the spread between Malaysian palm oil prices and Argentinian soybean oil prices. The spread never really blew out as much as it did on the U.S. side, although it did blow out a bit. But it has gotten down to the sort of 5-cent range, which is kind of where it has been, where it's very close to the long-term average. And so at 5 cents, then the economic advantage of palm oil is offset a bit by the concerns about the environment, and then also by the relative difference in quality. Somebody that uses a lot of veg oil will probably argue with me a little bit on that one, but there's a price structure, and soybean oil prices are usually more expensive than palm oil prices, and I think that's for a reason. Anyway, 5 cents is pretty close to the long-term average. And so for a lot of people that would have been substituting palm oil for soybean oil, sorry. Actually, that would make it different. This person told me this, and I thought about it, and it doesn't make sense. If the spread is smaller, it should encourage. Oh yeah, sorry, it is correct. Sorry. Yeah, it would encourage more soybean oil use and less palm oil use, and so that's part of what happened, or that's part of what this person's theory was about what happened to Malaysian palm oil exports, and what potentially could happen to Malaysian palm oil exports going forward, that they might be a little bit weaker, especially if we get a big crop out of South America. Again, probably doesn't do much during the first quarter, but after that, then it will become significantly more important. So, okay, here's what we have for exports. You can see exports have been pretty close and pretty steady relative to the 5-year average and relative to each of the individual months for the last couple of years, and we expect them to remain there. However, again, especially if you get the spread between palm oil and U.S. soybean oil to narrow, I don't think that the U.S. is going to go back to exporting 2 billion pounds of soybean oil. But to the extent that there will be a premium for the U.S. versus Argentina, and that may mean that Argentina prices are even lower, then you could have palm oil exports outperforming our forecast. However, it seems more likely that that the spread between the U.S. and Malaysian palm oil prices will bottom out in the next couple of months around 15 cents and then slowly start to work its way back to around 20 cents or so as we get towards the end of the marketing year. And again, whether that happens or not, a bit of that will depend on the size of the South American crop, or there will be a significant amount of that depends on the South American crop. Now, while Malaysian palm oil exports have been relatively steady for the last couple of years, the same has not been true in Indonesia, where there has been relatively steady growth in palm oil shipments. Now, last year, Southeast Asian palm oil exports totaled 40.6 million tons, and that was up 16% from the year before. We expect that that there will be a little bit of growth in 23-24, but not like we saw. And while the 16% year-over-year change was pretty dramatic, it wasn't. It was getting Southeastern Asian palm oil exports sort of back to the level that we had seen historically, in part because of the increase in Indonesian shipments have really driven that. And so that level isn't necessarily unsustainable, but it will depend a lot on consumers' desires to support sustainably sourced vegetable oil. So that trend is not new. It's been going on for a while, and it has had an impact on palm oil trade. Some part of that seems to be waning a little bit. If you think of it sort of this way, that there was 10 years ago or 15 years ago, people were really concerned about it because the peat fires in Indonesia were sitting up all of Southeast Asia for a little while. And so then you had a real significant impact. And as you get further away from that event, the impact gets less and less. Plus, just the demand grows naturally from growth in the economy and growth in population. And so we kind of have round tripped, and now we're back to sort of where we were before. And so we should kind of grow slowly from here going forward, particularly because the palm oil industry has done a lot of work to try and get the information that buyers would need to be confident that the palm oil that they're buying is sustainably sourced. All right, just a little over, not quite where I wanted to be, but there are a couple of questions and I wanted to leave some time. I noticed your LCFS credit forecast reaching 150 in Q4 2024. Are you expecting CARB to move targets enough to correct the market upwards? Why isn't that view already baked into the market today? We still see prices in the $70 area. The LCFS forecast is one that we're changing a little bit the way that we do it, and so that might be part of it. However, probably the bigger part of it is that, at least the way that I read it, CARB hasn't fully decided how it's going to change the program yet, and it looks like it might be mid next year before they do make those changes. And it looks like the changes will be a reduction in the carbon intensity targets. And I think there are even, well, I know there's even a table that shows what the new targets would be. I go back and forth a little bit on LCFS and CARB changes and the impact on prices. So I can pretty easily convince myself that anything that CARB does to raise credit prices only attracts more biofuel, which pressures prices. And so you get what the person that sent this question in is sort of pointing out, which is the market may already know this and it's already pricing it in, because if we get LCFS credit prices up to 150, then we're just going to get a lot more supply, and that is going to pressure prices and take them back down to the level where they are now. And that, I think, has some merit. However, I also think that the people at CARB probably also understand that and know that, and will try to make changes that will sustainably support the price. Not sustainably in an environmental way, but in a longer term way. And whether the reduction in the carbon intensity targets is enough to do that or not, I think is an open-ended question, because CARB has not made that kind of adjustment to the program that I've seen. And so when they do that, what they effectively do is there's really two sides to it. So when they do it, they make it harder to generate credits, but they also make it easier to generate deficits. And so when I get into this argument about CARB changes the credit intensity table, that raises credit prices, that attracts more supply, and then that pushes prices down, the part that I sort of use to argue against that, or that I think of after that, is that on the credit generation, deficit generation side of that, if you are making deficit generation that much easier, I think, and I don't have any reason to think this other than my life's experience in trying to guess at what's going to happen in the future. It may be that deficit generation becomes much easier, and so you get much more of a balance in the credit bank because the deficit generation is easier, and that's almost the more important part of it than that credit generation is more difficult. I don't know that that's true, and like I said, I don't have any real reason to believe that, other than that just seems to be the way that things work out a lot of the time. The other thing that I would argue is that we already send 85% or so of renewable diesel to the California market. And so while I can make the argument that if they make changes and raise prices, they're going to attract more supply that's going to pressure prices, there's only so much supply that can actually, only so much that supply can grow in California for renewable diesel, at least. For biodiesel, it's a much smaller, it's like 15% or so of US supplies end up, or US production ends up in the California market. So you could argue that in 2024 and particularly in 2025, with the shift to the IRA credit from the blender's tax credit, that all biomass-based diesel producers are going to be looking for as much revenue as they can possibly get. And so it may be that the portion of the domestic biodiesel production that we send to California rises, and that's how we pressure prices. But I don't know that that's going to happen either, because I think that there probably is local demand for that biomass-based diesel, or for that biodiesel. There are also state level incentives for biodiesel, and so maybe you get an increase in biodiesel, and maybe you get an increase in renewable diesel, and maybe all of that keeps prices at 70, or between 70 and 90, let's say, through 2024, 25, and out into the future. But I think that I think CARB really wants to get the price for LCFS credits back up to encourage other alternative energy sources outside of the liquid fuels. And so to the extent that they can do that without necessarily attracting enough liquid fuel to the market to pressure prices lower, I think that's probably really their goal, because I don't think what they're really trying to do is sort of set up a market where they encourage a lot, even though this is what they've done, but they encourage a lot of additional production of liquid biofuel. I think they would, like, as much of the, as many ICE engines, as many internal combustion engines as possible taken off the road in passenger cars and in semi trucks and beyond. I don't mean that like they want them taken. I mean they would just prefer that all of that stuff be driven by electricity as opposed to by liquid fuels at all. And so I think they will try and make changes that will drive prices high enough to encourage other sources of energy. For D4 RINs, do you see room for an upward correction in 2024? What are the drivers for this? The main driver that that will cause RIN prices to go higher is, of course, rising feedstock prices. I was just looking at our soybean oil forecast before I jumped on here, and for the first half of 2024, we have soybean oil prices that are around this level or maybe a little bit lower for one reason, and that is because as you take soybean prices down, unless you take crush up, the crush margin, then product prices have to follow soybean prices. And so even if you take soybean prices down and meal prices down and hold crush margins steady, it still is relatively tough to keep soybean oil prices moving higher given the implications for oil share. So I could easily say next year in the first quarter that soybean oil is going to average 60 cents a pound. But if I go in and I look at what that means, given what today's crush margins are and where soybean prices are, if I go in, that's going to imply some price for soybean meal, and it's also going to imply some oil share. And if you ever look at a chart of oil share, one of the reasons that we use it in our price forecasts is because it doesn't trend. It's not super volatile. It tends to trend one way and then trend the other relatively slowly. I think after the last couple of years where it has moved around more than it usually has, I think, especially if this first quarter shortage is correct, that we could be setting up for an increase in oil share that's relatively aggressive. And that's kind of where our forecast is going. But with soybean prices coming down, it's hard to even keep soybean oil prices steady, let alone have them go up a lot. And so if we have a big South American crop and that pressures soybean future prices, then it will also on some level pressure soybean oil prices, even if that pressure just means that soybean oil prices stay steady as soybeans and soybean meal fall, and then soybean oil and crush margins, or soybean oil stays steady and crush margins fall, but less than soybeans or soybean meal. So in 2024, because of our outlook for soybeans, we don't really have a big increase in feedstock costs, because it's just hard to get soybean oil prices to rise given the constraints that we have. And so I don't know that we're going to see a lot of support for RINs from feedstock costs. That said, I think that depending on where production of biodiesel and renewable diesel ends up in the last couple months of the year, people's expectations for next year may be set a little bit lower than they would have been otherwise because of what's happened to margins over the last couple of months. And so if that happens, then you could get a cut in production enough so that not necessarily the D4 relative to the advanced mandate overproduction entirely goes away, but enough so that I showed, maybe not last week, maybe it was 2 weeks ago, the gap between our expectation for total RIN generation and the mandates. If that verifies and that ends up being true, at some point the overall shortfall could trigger a sharp rally in D4 RIN prices. And I think that may be more likely than a big increase in feedstock costs, assuming normal weather going forward in South America and normal weather in the US next year. However, the next year, so for 24, 25, then we have soybean oil prices moving up closer to 55 or 60 cents. I think the average price for the marketing year might be 58 or something like that. Whereas I think this year it's probably 52-ish, maybe a little above that. And so, well, 2024, I think it might take something a little weird to get a big rally in RIN prices, like either a big reduction in biodiesel capacity or a break of the D6 above the D4 because the shortfall in total RINs. But I think it would be something like that would really, really drive RIN prices higher. Our models really want to forecast or predict the separation between the D4 and the D6, and would like to forecast D4 RIN prices higher. We've adjusted that the last several weeks. It's been trying to do that for a couple of months now, and we've continued to moderate what it wants to do a little bit. But at some point it may be that is what really happens, that we really do get the market to change its outlook for RINs from the current outlook, which is we're so overproducing D4 RINs that it's weighing on every RIN price, to one that is, oh wow, we're overproducing D4, but we're short total RINs. And if that is the case, then I think it's going to be something that we haven't necessarily seen before. The feedstock cost is the primary driver of RIN prices, except in years, I guess, where you have a huge hangover of RINs or a huge carryover of RINs. And so I would always sort of just routinely kind of say, feedstock costs will be the driver of RIN prices up or down next year, no matter what. So given whatever your expectations are for feedstock prices, that should be relatively close to your expectations for RINs. However, given, again, the overproduction in D4, we've seen a departure in the way that RIN prices work. At least I think there's been a departure in the way RIN prices work than they have historically. That's not been an opinion that I've come to easily, as some of you on here will know, because we've talked a lot about it. But it is something that I think is true this year that may not be true going forward. We're not adding a component to our model that more explicitly includes the overproduction or underproduction of RINs. However, if next year looks a lot like this year, then we may end up doing that at some point. But I think that you probably will get the overproduction of D4 sorted out in the next year or so, and then RIN prices will kind of go back to what they normally do. The other thing that the RIN market needs, I think, oddly, to rally would be more ethanol production, because I think part of what's gone on is that there's such a big shortfall in ethanol that the market knows it needs more biomass-based diesel, and that helped encourage a lot of the production capacity build out, which in turn has led to overproduction of D4 prices coming down and weighing on D6, even though D6 there's a big shortfall there. All right, this was the penultimate, I always love saying that word, webinar for this year. Next week will be the last one for the year, and then we won't do one or print a report the week between Christmas and New Year's. So I hope everybody has a great week, and thanks again for coming, and thanks so much for the questions, and I will see you all next Tuesday. Have a great week, everybody. Bye-bye.